what I'm going to do is I'm going to talk about reporting and analyzing receivables. You can see my learning objectives right here: identify the types of receivables and record accounts receivable transactions. We're actually going to focus on recording account receivable transactions, account for credit losses, explain the statement presentation of receivables, and apply the principles of sound accounts receivable management. So our agenda is to do 4 years of a company called JayZee Inc. And I'm going to focus on understanding the flow and the reason for using an allowance for credit losses, because that causes a lot of confusion for students. Note that for these questions, I'm really focusing on accounts receivable. Sure, I know a business has a lot of other activities, a lot of other transactions, purchasing insurance, getting, furniture, renting space. I'm not going to focus on any of those. I'm going to ignore all of those for purposes of this demonstration. My focus is going to be on managing accounts receivable. So let's start with JayZee for year 1. You begin JayZee Inc., a new business, on January 1st, year 1. The business sells all natural dog food to retail pet stores in Toronto, Ontario. You have only a few customers as you are just starting out. All customers are provided with the following credit terms: N45. That's net 45. That means they have to pay within 45 days. So why would you give them terms of N45? Well, because you want to generate business with new customers, and new customers aren't likely to purchase a brand new product that they've never had in their store before unless you're willing to fund it, which is what you're doing when you sell on account. You are funding your customer's business because they can sell the product that they haven't even paid for yet. So you are encouraging customers to pick up your product by offering them advantageous terms. Since the business is small, you regularly visit each of your customers to see if they need additional products. At the same time, you follow up on outstanding invoices. This year, you were fortunate that all customers paid within the terms. Not surprising, because you're constantly following up with them. You expect the same next year. At this time, expected returns from customers are 0, and that's probably because you're not getting any returns from your customers. They're only buying small quantities because they don't know yet whether their customers want your product. The following summary business activities, and so I'm doing summary business activities, which represent the whole year. And that's because it's easier to do. Like, nobody wants to do hundreds of entries, right? So we're going to do summary entries to demonstrate these concepts. Were recorded in your first year of operations, which ended on December 31st, year 1. So I've got my transaction number, my description, and my amounts. So part A, record each of the business activities in the general journal. So let's get started. I do want to have a T account for accounts receivable, and I'm going to use the short form AR. Okay, so we've got transaction number 1, and it says total sales during the year. All sales are net 45, which we already know, $280,000. So what did we get? We got the legal right to collect cash from our customers, and that's, of course, accounts receivable. And that was $280,000. What did we give away? Well, we gave away a product which gave us the right to claim revenue. So we've got a credit to sales revenue. Same $280,000. My accounts receivable is going to go up by $280,000. I'm not going to track sales revenue right now because there's only one transaction. Transaction 2. It says the total cost of inventory sold was $112,000. So I'm going to do a debit to cost of goods sold. That's because we used or consumed the inventory in order to help generate revenue, so I can claim an expense. Cost of goods sold is an expense. What did I get rid of? I have to credit inventory. Same amount. Now, I know we're not tracking inventory with a T account. We're focusing on accounts receivable. 3. Cash collections of accounts receivable were $245,000. So what did we get? A debit to cash, $245,000. And our credit is to accounts receivable, because the accounts receivable, of course, disappear. We've collected them. We no longer have a legal right to collect the $245,000 because we've already done it. So accounts receivable is going to go down by $240,000. Now, 4, at the end of the year, you estimate that no accounts receivable will be uncollectible in the upcoming year, 0%. Okay, think what this means. It means that you think that you can collect the total accounts receivable. So let's just look at what the total accounts receivable is. So you think you can collect the total balance in accounts receivable, which is now $35,000. To calculate uncollectible accounts, we take the ending balance in accounts receivable. So if we wanted to calculate uncollectible accounts, we take the balance, the ending balance in AR, and we multiply it by the percentage that we determine is uncollectible. So in this case, we're going to take the 35,000 and we're going to multiply it by 0%, which of course is going to be equal to 0, right? I mean, if I do that math, it's 0. So in this case, you think 0 is uncollectible. Doing this calculation, it means that the uncollectible amount is going to be $0. What does this mean about the $35,000? It means that you believe the future economic benefit of your AR is equal to the balance, $35,000. That's because you believe this is 100% collectible. So for transaction number 4, there's no entry. And there's no entry because you believe you can collect 100% of the $35,000. Let's move on to part B. Why is it appropriate that you have ignored the issue of accounts receivable not being collectible in the upcoming year? First, you haven't ignored this at all, right? You have actually considered the issue of whether the accounts receivable of $35,000 is collectible. So what did you do? You reviewed the AR, and for the past year, you have been able to collect 100% of the AR. So you have some historical information. It indicates 100% collectible, right? You follow up with your customers regularly, and you plan to continue to do so. Right? If it's worked till now, you're probably going to continue doing that. So you have to think it's reasonable to assume that 0% will be uncollectible in the future, in the upcoming year. So remember, you haven't ignored, oh, look, I spelled the word wrong. There we go. So remember, you have not ignored anything. You've assessed the outstanding accounts receivable at the end of the year and determined that 100% is collectible and 0 is uncollectible, which is exactly what you need to do. Let's move on to part C. Calculate the accounts receivable turnover ratio and the average collection period. First, let's look at what those calculations actually are. What are those formulas? So I'm just going to pop the formulas in here. Receivable turnover is credit sales divided by the average gross accounts receivable. So credit sales are all the sales you sold on credit, and the average gross accounts receivable is equal to the opening accounts receivable plus the closing accounts receivable, all divided by 2. Now, keep in mind, this is gross accounts receivable, and gross accounts receivable are before the allowance for credit losses. Why do companies calculate the receivable turnover? Well, it's because you need to keep a watchful eye on the relationship between sales, accounts receivable, and collections of cash. If sales increase, you would expect accounts receivable to increase also, right? Because if you're selling more, you're probably selling more on credit. But if accounts receivable is increasing and sales are not, or accounts receivable is increasing and sales are going down, that would really tell you that you have collection problems, right? Perhaps you're extending credit to uncredit-worthy companies, right? Customers, or you just have an impossible time collecting from your customers. Keep in mind, this is an issue of liquidity. Liquidity is how quickly assets are converted into cash. So the receivable turnover really tests that. So let's just do the calculation here. We know that credit sales were equal to $280,000. Now, we don't have an average gross accounts receivable because we don't have a balance from last year. So we're just going to use this year's ending balance in accounts receivable. We're going to do the calculation, and we can see that this is equal to 8.00. What does that mean? It means that 8 times, so let's put the word times, 8 times per year, you go from selling your accounts receivable to getting the money for the accounts receivable. It's the number of times on average that receivable are collected during the year. The number of times that we sell something on account and then collect it. Now, is this good or bad? And the answer is we can't tell. Not really. We can only tell if a ratio is good or bad if we have something to compare it to, such as the industry average or the ratio from past years. In this case, we don't have any of that information, so we can't say anything about whether this is good or bad. But what we can do is we can calculate the average collection period. This is a really useful variant of the receivable turnover because it converts it to the number of days it takes for a company to collect their accounts receivable. So it's often used to assess the effectiveness of a company's credit and collection policies. The general rule is that the collection period shouldn't be greater than the credit terms that you're providing to your customers. So we take the 365 days and we divide it by the receivable turnover. And if we do this, we can see that it is 45.625 days. We know that our terms are net 45. So we can see that we are doing a very good job in collecting our accounts receivable within the terms that we've provided to our customers. And this is a positive message in this company with regards to our ability to collect the cash from our customers and quickly enough given our credit terms. I do want to mention something right here with regards to credit sales. So unfortunately, companies rarely report the amount of credit sales on their financial statements. So be aware if a company doesn't report the amount of credit sales, including both cash sales and credit sales, you have to use that as a substitute. And as long as you consistently choose the same basis for calculating the ratio, the outcome of this ratio is useful for period-to-period comparisons. And since all companies, even if we wanted to compare two companies within the same industry, since most companies or almost all companies don't report credit sales, we're using the same base information to calculate the ratios to compare the two companies. All right, let's move on to part D, show the statement of financial position presentation at year end for JayZee. So we would, of course, start with assets and then current assets. We would have cash, but we're not tracking that, so we don't know what it is. And then we would have accounts receivable. And that would be our ending balance in this case, which is $35,000. Part E, show the income statement presentation at year end for JayZee. So on the income statement, and let's assume they're using a multiple step income statement, we would have sales revenue, and we know what that sales revenue is. That sales revenue is right up here, 280,000. We would have the cost of goods sold, and that would be the amount we have up here as the cost of goods sold, 112,000. And this, of course, would give us gross profit. So our gross profit is $168,000. And then we would have our operating expenses. And then we would have income from operations, etc. We don't have any of that information, but we do know that we've got the cost of goods sold and we've got the sales revenue. All right. In the next video, I'll move on to year 2.